So Aisha, look, there is no panic in the world.
Yeah.
And there is no panic even in the bond market, there is no panic in equities, and there is no big uptick which has happened even in gold or for that matter. There is no safe haven buying which is visible in the US bond market. So you would say that what is happening in terms of the geopolitical crisis, yes, it is important. Yes, political leaders have started posturing, and they've started talking to each other to find an early solution, and this entire geopolitical tension perhaps may just linger itself for next couple of not days but couple of weeks. But frankly, from a financial market standpoint, what is the message from the financial market? Something which we indicated yesterday, I think has turned out to be true, which is that this is not Russia versus Ukraine. This is very localized, and this is unlikely to have an impact in terms of the financial disruption, and I think that is happening. So whether it is the US 10-year paper, the handover from US markets last night, how Asian markets are moving today. Asia, large part of Asia was shut yesterday, so they are reacting to the news today. And frankly, if you look at the US dollar index also, and even oil, which is the most sensitive, sensitive commodity, there is no panic, there is no fear, there is minor adjustment. Traders were looking for a reason to book profits, and both locally and globally, they got one yesterday.
Yes, indeed. So just to, elaborate a little bit more on that, you did have the global markets, which initially started off lower, but then you did see some sort of a recovery kicking in. So it was for the flat line for the most part. When it came to the US markets, you've got the Asian screen as well, pretty much shaking off a lot of those pressures that we've seen coming in from the geopolitical concerns, and they're holding out in the green. And even when it comes to crude oil prices, you did see a little bit of an edge down just yesterday after the crude oil prices gained more than 4% in the previous session. But on D Street then, and our own markets, by the time we wrapped up, it was a 140-point downtick. We did snap that two-day gaining streak that we witnessed on Friday as well as on Monday, and it looks like it's been confined to a very tight range for the markets. So 19,450 to 19,650 is the kind of range that the markets have been confined to for the past 11 trading sessions. And not just that, you've also got the 10-year GSEC, which has hardened to about 7.3%. So yes, we did snap that two-day gaining streak, Nikunj. The broader markets were under pressure, but like you said, to a large extent, not really taking into cognizance the kind of geopolitical concerns.
See, a subtle correction had already started in broader market. You look at some of the railway stocks, defense stocks, power stocks, they are down double digit from the recent highs. So the markets have already started correcting, and yesterday the market correction in mid and small cap stocks only amplified. So a overbought market or an extremely overbought market was looking for reasons to correct, and there were plenty of factors which were at play yesterday. Now this is important for us to look at in terms of the market setting. From the Wednesday's low, which is last Wednesday, when markets have made a comeback, Nifty is up 160 points, but the mid-cap index has not recovered at all. So while Nifty is up 150 points, the Bank Nifty also has come up by about 200-250 points from Wednesday's low. The mid-cap index actually has not has actually gone back almost to the Wednesday's low. So you actually could see a situation, because it's earnings season, that markets may now be, rather than talking about mid and small cap as a category, you actually would see within mid and small cap stocks a lot of individual stocks acting and reacting to numbers. So rather than momentum, view, market cap, profile of the stock, ownership, these were the factors which were driving some of the mid cap stocks in April, May, June, July, August. Now it could be numbers, it could be earnings, it could be projections. So what had happened, Aisha? EMS stocks, everything went up. Defense stocks, everything went up. Railway stocks, everything went up. Not every company will come up with universal, the numbers are not going to be universal in nature, because nature of business is like this. So I think now, like you say, boys will be separated from the men, wheat will be separated from the chaff. You actually will see within the mid-cap space that churn which will happen. So where companies are giving you decent amount of confidence and where valuations are supportive, those stocks will be disproportionately moving higher, and vice versa when it comes to underperformance and stocks which will lack the earning momentum.
The only thing is, and we discussed this yesterday as well, that it's been a consecutive 14-session selling spree that FIIs has seen. In fact, it's the longest in over 8 months. Apparently, the last time that we saw such incessant selling for 14 days, Nikunj, was back in December 23, 2022 to January 16, start of this year.
Okay, so what happened last time versus what is happening right now, the factors were at play. And the factor at the play which triggered the selling last time, the period you mentioned, was the yields were moving higher. Right now also yields are moving higher. Right now also the dollar index is moving higher. So this is more like a macro adjustment which is happening. And the macro adjustment, I think, is a function of what is happening to the dollar, what is happening to the flows, what is happening to the world and where Fed is likely to move. So I'm not surprised at all that foreign institutional investors, they sell. The history, however, has taught us that every time FIs have been big sellers and when they have been compulsive sellers, if you bought into stocks which they've owned, you actually are rewarded in the next 3 to 4 months. So I think the similar factor could be at play because large cap stocks are cheap. FIs are selling them, and if there is little bit more panic unwinding, let's say especially in banks, you actually should be a buyer there. I'm getting more and more convinced. I mean, not that I was not convinced, but I'm getting more and more convinced that you need to be overweight on banks. The numbers are good. Look at Bajaj Finance, 30% growth. Look at HDFC Bank. These are large banks. They represent the way wheels are moving in the financial sector. If some of these banks are growing at 25-30% and stocks are available at pre-COVID levels, you know, HDFC price to book is available at pre-COVID. Kotak Mahindra Bank pre-COVID. Bajaj Finance pre-COVID. The growth is extraordinarily high and the valuations are pre-COVID. Then what should you do? Buy them.
The answer is
And
obvious.
The spate of underperformance perhaps now is behind us for a lot of these large cap banks. Okay, that's Nikunj driving home the point that perhaps financials merit a relook and continue to remain convinced that it is a good time to buy.